Ladies and gentlemen, I would like to welcome you for a crash course about trading and investment. Today, I'm going to talk about the five important financial indicators, namely MACD, in short for Moving Average Convergence Divergence. Number two is volume indicator. Number three is stochastic 20. Number four is stochastic 12. They are both stochastic oscillators. And number five is the relative strength index, or RSI. The first on the list is MACD. It's a trading indicator used in technical analysis of stock prices, created by Gerald Appel in the late 1970s. It is designed to reveal changes in the strength, direction, momentum, and duration of a trend in a stock's price. The MACD indicator or oscillator is a collection of three time series calculated from historical price data, most often the closing price. These three series are the MACD series proper, the open quote signal end quote or open quote average end quote series, and the open quote divergence end quote series, which is the difference between the two. The MACD series is the difference between open quote fast end quote, a short period exponential moving average or EMMA, and open quote slow end quote a longer period EMMA of the price series. The average series is an EMMA of the MACD series itself. The MACD indicator thus depends on three time parameters, namely the time constants of the three EMMAs. The notation open quote MACD A, B, and C end quote usually denotes the indicator where the MACD series is a difference of EMMAs with characteristic times A and B, and the average series is an EMMA of the MACD series with characteristic time C. These parameters are usually measured in days. Most commonly used values are 12, 26, and 9 days. That is MACD 12, 26, and 9. As true with most of the technical indicators, MACD finds its period settings from the old days when technical analysis used to mainly based on the daily charts. The reason was the lack of modern trading platforms which shows the changing prices every moment. As the working week used to be 6 days, the period settings of 12, 26, 9 represents 2 weeks, 1 month, and 1.5 week. Now, when the trading weeks have only 5 days, possibilities of changing the period settings cannot be overruled. However, it is always better to stick to the period settings which are used by the majority of traders, as the buying and selling decisions based on the standard settings further push the prices in the direction. The MACD and average series are customarily displayed as continuous lines in a plot whose horizontal axis is time, whereas the divergence is shown as a bar graph, often called a histogram. A fast EMMA responds more quickly than a slow EMMA to recent changes in a stock's price. By comparing EMMAs of different periods, the MACD series can indicate changes in the trend of a stock. It is claimed that the divergence series can reveal subtle shifts in the stock's trend. Since the MACD is based on moving averages, it is inherently a lagging indicator. As a metric of price trends, the MACD is less useful for stocks that are not trending, that is trading in a range, or are trading with erratic price action. Terminology. Over the years, elements of the MACD has become known by multiple and often overloaded terms. The common definitions of particularly overloaded terms are divergence, number 1, As the D in MACD, divergence refers to the two underlying moving averages drifting apart, while convergence refers to the two underlying moving averages coming towards each other. Number 2, Gerald Appel referred to divergence as a situation where the MACD line does not conform to the price movement. Example Gracia, a price low is not accompanied by a low of the MACD. And 3, Thomas Asprey dubbed the difference between the MACD and the signal line the divergence series. In practice, definition number 2 above is often preferred. Histogram number 1. Gerald Appel referred to bar graph plots of the basic MACD time series as histogram. In Appel's histogram, the height of the bar corresponds to the MACD value for a particular point in time. Number 2, the difference between the MACD and its signal line is often plotted as a bar chart and called a histogram. In practice, definition number 2 above is often preferred. Mathematical interpretation. In signal processing terms, the MACD series is a filtered measure of the derivative of the input price series with respect to time. The derivative is called velocity in technical stock analysis. MACD estimates the derivative as if it were calculated and then filtered by the two low-pass filters in tandem, multiplied by a gain equal to the difference in their time constants. It also can be seen to approximate the derivative as if it were calculated and then filtered by a single low-pass exponential filter, EMMA, with time constant value to the sum of time constants of two filters multiplied by the same gain. For the standard MACD filter time constraints of 12 and 26 days, the MACD derivative estimate is filtered approximately by the equivalent of low-pass EMMA filtered for 38 days. The time derivative estimate per day is MACD value divided by 14. The average series is also a derivative estimate with an additional low-pass filter in tandem for further smoothing and additional lag. The difference between the MACD series and the average series, the divergent series, represents a measure of the second derivative of price with respect to time, acceleration in technical stock analysis. This estimate has the additional lag of the signal filter and additional gain factor equal to the signal filter constant. Classification. The MACD can be classified as an absolute price oscillator, APO, because it deals with the actual prices of moving averages rather than the percentage changes. A percentage price oscillator, PPO, on the other hand, computes the difference between two moving averages of price divided by the longer moving average value. While an APO will show greater levels of higher price securities and smaller levels for lower price securities, a PPO calculates changes relative to price. Subsequently, a PPO is preferred when comparing oscillator values between different securities, especially those with substantially different prices, or comparing oscillator values for the same security at significantly different times, especially a security whose value has changed greatly. Another member of price oscillator family is the trended price oscillator, DPO, which ignores long-term trends while emphasizes short-term patterns. Trading interpretation. Exponential moving averages highlight recent changes in a stock's price. By comparing EMMAs of different lengths, an MACD series gauges changes in the trend of a stock. The difference between the MACD in series and its average is claimed to reveal subtle shifts in the strength and direction of a stock's trend. It may be necessary to correlate the signals with the MACD to indicators like RSI power. Some traders attribute special significance to the MACD line crossing the signal line or the MACD line crossing the zero axis. Significance is also attributed to disagreements between the MACD line or the difference line in the stock price, specifically higher highs or lower lows on the price series that are not matched in the indicator series. Signal line crossover. Open quote signal line crossover, end quote, occurs when the MACD and line average line cross, that is, the divergence, the bar graph changes sign. The standard interpretation of such an event is a recommendation to buy if the MACD line crosses up through the average line, a bullish crossover, or to sell if it is crosses down through the line, a bearish crossover. These events are taken as indications that the trend in the stock is about to accelerate in the direction of the crossover. Zero crossover. Open quote zero crossover end quote event occurs when the MACD series changes sign, that is, the MACD line crosses the horizontal zero axis. This happens when there is no difference within the fast and slow EMAs of the price series. A change from positive to negative MACD is interpreted as bearish, and from negative to positive as bullish. Zero crossovers provide evidence of a change in the direction of a trend, but less confirmation with momentum than a signal line crossover. Divergence. Open quote positive divergence end quote, or open quote bullish divergence end quote, occurs when the price makes a new low but the MACD does not confirm with a new low of its own. Open quote negative divergence end quote, or open quote bearish divergence end quote, occurs when a price makes a new high but the MACD does not confirm with a new high of its own. A divergence with respect to price may occur in the MACD line and or the MACD histogram. Timing. The MACD is only as useful as the context in which it is applied. An analyst may apply the MACD to a weekly scale before looking at the daily scale. In order to avoid making short-term trades against the direction of the intermediate trend, analysts will also vary the parameters of the MACD to track trends of varying duration. One popular short-term setup, for example, is the 3-35-5 false signals. Like any forecasting algorithm, the MACD can generate false signals. A false positive, for example, can be a bullish crossover followed by a sudden decline in a stock. A false negative would be a situation where there is a bearish crossover, yet the stock accelerated suddenly upwards. A prudent strategy may be to apply a filter to signal the line crossovers to ensure that they have held up. An example of a price filter would be to buy from the MACD line breaks above the signal line and then remains above it for 3 days. As with any filtering strategy, this reduces the probability of false signals, but increases the frequency of missed profit. Analysts use a variety of approaches to filter out false signals and confirm true ones. MACD crossover of a signal line indicates that the direction of the acceleration is changing. The MACD line crossing zero suggests that the average velocity is changing direction. The second in line is called the volume indicator. In capital markets, volume or trading volume is the total number of a security or a given set of securities, or an entire market that was traded during a given period of time. In the context of a single stock trading or on a stock exchange, the volume is commonly reported as the number of shares that change hands during a given day. The transactions are measured on stocks, bonds, options contracts, futures contracts, and commodities. The average volume as a security over a long period of time is the total amount traded in that period, divided by the length of a period. Therefore, the unit of measurement for average volume is shares per unit of time, typically per trading day. Significance. Trading volume is usually higher when the price of a security is changing. News about a company's financial status, products, or plans, whether positive or negative, usually result in a temporary increase in the trade volume with stock. Chips in a trade volume can make observed price moves more significant. High volume for a stock is an indicator of higher liquidity in the market. For institutional investors who wish to sell a large number of shares of a certain stock, a lower liquidity will force them to sell the stock slowly over a period of time to avoid losses due to slippage. Legal implications. In the United States, the Rule 144 of the Securities Act of 1933 restricts the buying and selling of an amount of a security that exceeds a certain fraction of its average trading volume. Therefore, the calculation of the trading volume is regulated by the SEC. Stochastic oscillator definition, reviewed by Adam Hayes, updated June 30, 2019. What is a stochastic oscillator? A stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. The sensitivity of an oscillator to market movements is reducible by adjusting that time period or by taking a moving average of the result. Is used to generate overbought and oversold trading signals utilizing a 0 to 100 bounded range of values. Key takeaways. A stochastic oscillator is a popular technical indicator for generating overbought and oversold signals. It was developed in the 1950s and still in wide use to this day. Stochastic oscillators are sensitive to momentum rather than absolute price. The formula for the stochastic oscillator is %K equals open parenthesis C minus L14 divided by H14 minus L14 close parenthesis times 100, where C is equals the most recent closing price, L14 the lowest price traded of the 14 previous trading sessions, H14 the highest price traded during the same 14-day period, %K the current value of the stochastic indicator. %K is referred to sometimes as the slow stochastic indicator. The open quote fast end quote stochastic indicator is taken as %D equals 3-period moving average of %K. The general theory serving as the foundation for this indicator is that in a market trending upwards, the general theory serving as the foundation for this indicator is that in a market trending upward, prices will close near the high, and in a market trending downward, prices close near the low. Transaction signals are created with the %K crosses through a 3-period moving average, which is called the %D. What does a stochastic oscillator tell you? The stochastic oscillator is range bound, meaning it is always between 0 and 100. This makes it a useful indicator of overbought and oversold conditions. Traditionally, readings over 80 are considered in the overbought range, and readings under 20 are considered oversold. However, these are not always indicative of impending reversal. Very strong trends can maintain overbought or oversold conditions over an extended period. Instead, traders should look for changes in the stochastic oscillator for clues about future trend shifts. Stochastic oscillator charting generally consists of 2 lines, one reflecting the actual value of the oscillator for each session, and one reflecting its 3-day simple moving average. Because price is thought to follow momentum, intersection of these 2 lines are considered to be a signal that a reversal may be in the works, as it indicates a large shift in momentum from day to day. The divergence between the stochastic oscillator and trending and price action is also seen as an important reversal signal. For example, when a bearish trend reaches a new lower low, but the oscillator prints a higher low, it may be an indicator that bears are exhausting their momentum and a bullish reversal is brewing. The stochastic oscillator was developed in the late 1950s by George Lane. As designed by Lane, the stochastic oscillator presents us the location of the closing price of a stock in relation to the high and low range of a price of a stock over a period of time, typically a 14-day period. Lane, over the course of numerous interviews, has said that the stochastic oscillator does not follow price or volume or anything similar. Indicates the oscillator follows the speed of momentum of price. Lane also reveals in the interviews that As a rule, the momentum or speed of the price of the stock changes before the price changes itself. In this way, the stochastic oscillator can be used to foreshadow reversals when the indicator reveals bullish or bearish divergences. This signal is the first and arguably the most important trading signal Lane identified. Example of how to use a stochastic oscillator. The stochastic oscillator is included in most charting tools and can be easily employed in practice. The standard time periods used is 14 days, though this can be adjusted to meet specific analytical needs. The stochastic oscillator is calculated by subtracting the low of the period from the current closing price, dividing by the total range for the period and multiplying by 100. As a hypothetical example, if the 14-day high is $150, the low is $125, and the current close is $145, then the reading for the current session would be open parenthesis 145 minus 125 close parenthesis divided by 100 open parenthesis 150 divided by 125 close parenthesis times 100 or 80. By comparing the current price to the range over time, the stochastic oscillator reflects the consistency with which price closes near its recent high or low. A reading of 80 would indicate that the asset is on the verge of being overbought. A difference between the relative strength index, open parenthesis RSI, close parenthesis, and the stochastic oscillator. The relative strength index RSI and stochastic indicator are both price momentum oscillators that are widely used in technical analysis. While often used in tandem, they each have different underlying theories and methods. The stochastic oscillator is predicted on the assumption that closing prices should close near the same direction as the current trend. Meanwhile, the RSI tracks overbought and oversold levels by measuring the velocity of price movements. In other words, the RSI was designed to measure the speed of price movements, while the stochastic oscillator formula works best in consistent trading ranges. In general, the RSI is more useful in trending markets and stochastics more or so in sideways or choppy markets. Limitations of the stochastic oscillator. The primary limitation of the stochastic oscillator is that it has been known to produce false signals. This is when the trading signals generated by the indicator, yet the price does not actually follow through, which can end up as a losing trade. During volatile market conditions, this can happen quite regularly. One way to help with this is to take the price trend as a filter, where signals are only taken as if they are in the same direction as trend. Chart school, technical indicators and overlays, stochastic oscillator. Introduction. Developed by George C. Lane in the late 1950s, a stochastic oscillator is a momentum indicator that shows the location of the close relative to a high-low range over a set number of periods. According to an interview with Lane, the stochastic oscillator, open quote, doesn't follow price, it doesn't follow volume or anything like that. It follows the speed or the momentum of price. As a rule, the momentum changes direction before price, end quote. As such, bullish and bearish divergences in stochastic oscillator can be used to foreshadow reversals. This was the first and most important signal that Lane identified. Lane also used this oscillator to identify bull and bear setups to anticipate a future reversal. As the stochastic oscillator is range bound, it is also useful for identifying overbought and oversold levels. Calculation. The default setting for the stochastic oscillator is 14 periods, which can be days, weeks, months, or an intraday time frame. A 14-period %K used the most recent close. The highest high over the last 14 periods and the lowest low over the last 14 periods. %D is a 3-day simple moving average of %K. This line is plotted against %K as an act as a signal or trigger line. Interpretation. The stochastic oscillator measures the level of the close relative to a high-low range over a given period of time. Assume that the highest high equals 110, the lowest low equals 100, and the close equals 108. The high-low range is 10, which is the denominator in the %k formula. The lowest low equals 8, which is the numerator. 8 divided by 10 equals 0.80 or 80%. Multiply this number by 100 to find %k. %k would equal 30 if the close was at 103. Open parenthesis 0.30 or times 100. Close parenthesis. The stochastic oscillator is above 50, which when the close is in the upper half of the range, and below 50 when the close is in the lower half. Low readings, open parenthesis, below 20, close parenthesis, indicate that the price is near its low for the given period, for a given time period. High readings, open parenthesis, above 80, close parenthesis, indicate that price is near its high for the given time period. The IBM example above shows three 14-day ranges, open parenthesis, yellow areas, close parenthesis, with the closing price at the end of the period, red dotted line. The stochastic oscillator equals 91 when the close was at the top of the range, 15 when it was near the bottom, and 57 when it was in the middle of the range. Fast, slow, or full. There are three versions of the stochastic oscillator available in Sharp charts. The fast stochastic oscillator is based on George Lane's original formulas for %k and %d. In this fast version of the oscillator, %k can appear rather choppy. %d is the 3-day SMA of %k. In fact, Lane used %d to generate buy or sell signals based on bullish and bearish divergences. Lane asserts that the %d divergence is the open quote only signal which will cause you to buy or sell, close parenthesis, because %d in the fast stochastic oscillator is used for signals. The slow stochastic oscillator was introduced to reflect this emphasis. The slow stochastic oscillator smooths %k with a 3-day SMA, which is exactly what %d is in the fast stochastic oscillator. Notice that %k in the slow stochastic oscillator equals %d in the fast stochastic oscillator, chart 2. Fast stochastic oscillator. Fast %k equals %k basic calculation. Fast %d equals 3-period SMA of fast %k. Slow stochastic oscillator. Slow %k equals fast %k smooth with 3-period SMA. Slow %d equals 3-period SMA of slow %k. The full stochastic oscillator is a fully customizable version of the slow stochastic oscillator. Users can set the look-back period, number of periods for slow %k, and the number of periods for the %d moving average. The default parameters are used in these examples. Fast stochastic oscillator. Open parenthesis 14.3. Close parenthesis. Slow stochastic oscillator. Open parenthesis 14.3. Close parenthesis. And full stochastic oscillator. Open parenthesis 14.3 and 3. Close parenthesis. Full stochastic oscillator. Full %k equals fast %k smooth with X period of SMA. Full %d equals X period SMA of full %k. Overbought and oversold. As a bound oscillator, the stochastic oscillator makes it easy to identify overbought and oversold levels. The oscillator ranges from 0 to 100. No matter how fast the security advances or declines, the stochastic oscillator will always fluctuate within this range. Traditional settings use 80 as the overbought threshold and 20 as the oversold threshold. These levels can be adjusted to suit analytical needs and security characteristics. Readings above 80 for the 20-day stochastic oscillator would indicate that the underlying security was trading near the top of its 20-day high-low range. Readings below 20 occur when a security is trading at the low end of its high-low range. Before looking at some chart examples, it is important to note that overbought readings are not necessarily bearish. Securities can become overbought and remain overbought during a strong uptrend. Closing levels that are consistently near the top of the range indicate sustained buying pressure. In a similar vein, oversold readings are not necessarily bullish. Securities can also become oversold and remain oversold during a strong downtrend. Closing levels consistently near the bottom of the range indicate a sustained selling pressure. It is therefore important to identify the bigger trend and trade in the direction of this trend. Look for occasional oversold readings in an uptrend and ignore frequent overbought readings. Similarly, look for occasional overbought readings in a strong downtrend and ignore frequent oversold readings. Chart 3 shows Yahoo, YHOO with a full stochastic oscillator, open parenthesis 20, 5 and 5, close parenthesis. A longer look back period, 20 days versus 14, and longer moving average for smoothing, 5 versus 3, produce a less sensitive oscillator with fewer signals. Yahoo was trading between 14 and 18 from July 2009 until April 2010. Such trading ranges are well suited for the stochastic oscillator. Dips below 20 warn of oversold condition that could foreshadow a bounce. Moves above 80 warn of overbought conditions that could foreshadow a decline. Notice how the oscillator can move above 80 and remain above 80. Orange highlights. Similarly, the oscillator move below 20 and sometimes remain below 20. The indicator is overbought and strong when above 80. A subsequent move below 80 is due to signal some sort of reversal or failure at resistance red dotted lines. Conversely, the oscillator is bought oversold and weak when below 20. A move above 20 is needed to show an actual upturn in successful support test, green dotted lines. Chart 4 shows Crown Castle, CCI, with a breakout in July to start an uptrend. In the full stochastic oscillator, open parenthesis 20, 5, and 5, close parenthesis, was used to identify oversold readings. Overbought readings were ignored because the bigger trend was up. Trading in the direction of the bigger trends improves the odds. The full stochastic oscillator moved below 20 in early September and early November. Subsequent moves back above 20 signaled an upturn in prices, green dotted line, and continuation of the bigger uptrend. Chart 5 shows AutoZone AZO with a support break in May 2009 that started a downtrend. With a downtrend in force in the full stochastic oscillator, open parenthesis 10, 3, and 3, close parenthesis, was used to identify overbought readings to overshadow potential reversal. Oversold readings were ignored because of the bigger downtrend. The shorter look-back period, 10 versus 14, increases the sensitivity of the oscillator for more overbought readings. For reference, the full stochastic oscillator 25 and 5 is also shown. Notice that this less sensitive version did not become overbought in August, September, and October. It is sometimes necessary to increase sensitivity to generate signals. Bull-bear divergences. Divergences form when a new high or low in price is not confirmed by the stochastic oscillator. A bullish divergence forms when price records a lower low but the stochastic oscillator forms a higher low. This shows less downside momentum that could foreshadow a bullish reversal. A bearish divergence forms when the price records a higher high but the stochastic oscillator forms a lower high. This shows less upside momentum that could foreshadow a bearish reversal. Once the divergence takes hold, then chartists should look for a confirmation to signal an actual reversal. A bearish divergence can be confirmed with a support break on the price chart or a stochastic oscillator break below 50, which is the center line. A bullish divergence can be confirmed with a resistance break on the price chart or a stochastic oscillator break above 50. 50 and the important level to watch. The stochastic oscillator moves between 0 and 100, which makes 50 the center line. Think of it as the 50-yard line in football. The offense has a higher chance of scoring when it crosses the 50-yard line. The defense has an edge as long as it prevents the offense from crossing the 50-yard line. As a stochastic oscillator cross above 50 signals as the prices are trading in the upper half of their high-low range for the given look-back period. This suggests that the cup is half full. Conversely, a cross between 50 means that the prices are trading in the bottom half of the given look-back period. This suggests that the cup is half empty. Chart 6 shows the International Gambling Tech, IGT, with a bullish divergence in February-March 2010. Notice how the stock moved from a new low, but the stochastic oscillator formed a higher low. There are 3 steps to confirming this higher low. The first is a signal line cross and or move back above 20. A signal line cross occurs when %K, black, crosses %D, red. This provides the earliest entry possible. The second is a move above 50, which puts price in the upper half of the stochastic range. The third is the resistance breakout on the price chart. Notice how the stochastic oscillator moved above 50 in the late March and remained above 50 in the late May. Chart 7 shows calls, KSS, with a bearish divergence in April 2010. The stock moved to higher highs in early and late April, but the stochastic oscillator peaked in the late March and formed lower highs. A signal line crosses and moves below 80 did not provide good early signals in this case because KSS kept moving higher. The stochastic oscillator moved below 50 for the second signal and the stock broke support for the third signal. As KSS shows, early signals are not always clean and simple. Signal line crosses moves below 80 and moves above 20 are frequent and prone to whipsaw. Even after KSS broke support and the stochastic oscillator moved below 50, the stock bounced back above 57 and the stochastic oscillator bounced back above 50 before the stock continued sharply low. Bull-bear setups. George Lane identified another form of divergence to predict bottoms or tops, dubbed open quote setups, close parenthesis, end quote, sorry. Open quote setups, end quote. A bull setup is basically the inverse of a bullish divergence. The underlying security forms a lower high, but the stochastic oscillator forms a higher high. Even though the stock could not exceed its prior high, the higher high in the stochastic oscillator shows strengthening upside momentum. The next decline is then expected to result in a tradable bottom. Chart 8 shows Network Appliance NTAP with a bull setup in June 2009. The stock formed a lower high as the stochastic oscillator formed a higher high. This higher high shows strength in upside momentum. Remember that this is a setup, not a signal. The setups foreshadows a tradable low in the near future. And TAP declined below its June low and the stochastic oscillator moved below 20 to become oversold. Traders could have acted when the stochastic oscillator moved above signal line above 20 or above 50, or after NTAP broke resistance with a strong move. A bear setup occurs when the security forms a higher low, but the stochastic oscillator forms a lower low. Even though the stock held above its prior low, the lower low in the stochastic oscillator shows increasing downside momentum. The next advance is expected to result in an important peak. Chart 9 shows Motorola, MOT, with a bear setup in November 2009. The stock formed a higher low in the late November and early December, but the stochastic oscillator formed a lower low with a move below 20. This showed strong downside momentum. The subsequent bounce did not last long as the stock quickly peaked. Notice that the stochastic oscillator did not make it back above to 80 and turned down below its signal line in mid-December. Conclusion. While momentum oscillators are best suited for trading ranges, They can also be used with securities that trend, provided the trend takes on a zigzag format. Pullbacks are part of uptrends that zigzag higher. Bounces are part of downtrends that zigzag lower. In this regard, the stochastic oscillator can be used to identify opportunities in harmony with the bigger trends. The indicator can also be used to identify turns near support or resistance. Should a security trade near support with an oversold stochastic oscillator, look for a break above 20 to signal an upturn and successful support test. Conversely, should a security trade near resistance with an overbought stochastic oscillator, look for a break below 80 to signal a downturn and resistance failure. The settings on stochastic oscillator depend on personal preferences, trading style, and time frame. A shorter look-back period will produce a choppy oscillator in many overbought and oversold readings. A longer look-back period will provide a smoother oscillator with a fewer overbought and oversold readings. Like all technical indicators, it is important to use stochastic oscillators in conjunction with other technical analysis tools. Volume, support, resistance, and breakouts can be used to confirm or refute signals produced by the stochastic oscillator. Using with sharp charts. As noted above, there are three versions of stochastic oscillator available as an indicator on sharp charts. The default settings are as follows: fast stochastic oscillator, open parenthesis 14 and 3, close parenthesis; slow stochastic oscillator, open parenthesis 14 and 3, close parenthesis; and full stochastic oscillator, open parenthesis 14, 3 and 3, close parenthesis. The look-back period 14 is used for the basic %K calculation. Remember, %K in the fast stochastic oscillator is unsmooth, and %K in the slow stochastic oscillator is smooth with a 3-day SMA. The open quote 3 end quote in the fast and slow stochastic oscillator settings, open parenthesis 14 and 3, close parenthesis, sets the moving average periods for %D. Chartists looking for maximum flexibility can simply choose the full stochastic oscillator to set the look-back period. The smoothing factor for %K and the moving average for %D. The indicator can be placed above, below, behind the actual price plot. Placing the stochastic oscillator behind the price allows users to easily match indicator swings with price swings. Stochastic oscillator oversold upturn. This scan starts with stocks that are trading above the 200-day moving average to focus on those that are in a bigger uptrend. Of these, the scan then looks for stocks with a stochastic oscillator that turn up from an oversold level below 20. Open bracket type equals stock, close bracket, and open bracket country equals US, close bracket. And open bracket daily SMA, open parenthesis 20, and daily volume, close parenthesis, greater than 40,000, close bracket. And open bracket daily SMA, open parenthesis 60, and daily close parenthesis, is greater than 20, close bracket. And open bracket daily close greater than daily SMA, open parenthesis 200, and daily close parenthesis, close bracket. And open bracket yesterday's daily slow stochastic percentage K, open parenthesis 14 and 3, close parenthesis, is less than 20, close bracket. And open bracket daily slow stochastic %K, open parenthesis 14 and 3, close parenthesis, is greater than 20, close bracket. Stochastic oscillator overbought downturn. This scan starts with stocks that are trading below their 200-day moving average to focus on those that are in a bigger downtrend. Of days, the scan then looks for stocks with a stochastic oscillator that turned down after an overbought reading above 80. Open bracket type equals stock, close bracket, and open bracket country equals US, close bracket, and open bracket daily SMA, open parenthesis 20, and daily volume, close parenthesis, is greater than 40,000, close bracket, and open bracket daily SMA, open parenthesis 60, and daily close bracket, close parenthesis, is greater than 20, close bracket, and open bracket daily close is less than daily SMA, open parenthesis 200, and daily close parenthesis, close bracket, and open bracket yesterday's daily slow stochastics, percent K, open parenthesis 14 and 3, close parenthesis, is greater than 80, close bracket, and open bracket daily slow stochastic, percent K is open parenthesis 14 and 3, close parenthesis, is less than 80, close bracket. Further study. John Murphy's technical analysis of the financial markets has a chapter devoted to momentum oscillators and their various uses, covering the pros and cons as well as some examples specific to the stochastic oscillator. Martin Pring's technical analysis explains the basics of momentum indicators by covering divergences, crossovers, and other signals. There are 2 more chapters covering specific momentum indicators, each containing a number of examples. Number 3, stochastic oscillator. In technical analysis of securities trading, the stochastic oscillator is a momentum indicator that uses support and resistance levels. Dr. George Lane developed this indicator in the late 1950s. The term stochastic refers to the point of a current price in relation to its price range over a period of time. This method attempts to predict price turning points by comparing the closing price of a security to its price range. The 5-period stochastic oscillator in a daily time frame is defined as follows. Percent K equals 100 times open parenthesis price minus L5 close parenthesis divided by open parenthesis H5 minus L5 close parenthesis. Percent D is equals to open parenthesis K1 plus K2 plus K3 close parenthesis divided by 3 close parenthesis, where H5 and L5 are the highest and lowest prices in the last 5 days respectively, while percent D is the 3-day moving average of percent K, the last 3 values of percent K. Usually this is the simple moving average, but can be an exponential moving average for a less standardized weighting for more recent values. There is only one valid signal in working with the percent D alone, a divergence between percent D and the analyzed security. Definition. The calculation above finds the range between an asset's high and low price during a given period of time. The current security's price is then expressed as a percentage of this range, with 0% indicating the bottom of the range and 100% indicating the upper limits of the range over the time period covered. The idea behind this indicator is that prices tend to close near the extremes of the recent range before turning points. The stochastic oscillator is calculated where price is the last closing price. Low subset N, open parenthesis price, close parenthesis, is the lowest price over the last N periods. High subset N, open parenthesis price, close parenthesis, is the highest price over the last N periods. Percent D is a 3-period simple moving average of percent K, SMA subset 3, open parenthesis percent K, close parenthesis. Percent D is a slow, percent D minus slow is a 3-period simple moving average of percent D, SMA subset 3, open parenthesis, percent D, close parenthesis. A 3-line stochastics will give an anticipatory signal in percent K, a signal in the turnaround of percent D at or before a bottom, and a confirmation of the turnaround in percent D minus low. Typical values for N are 5, 9, or 14 periods. Smoothing the indicator over 3 periods is standard. Dr. George Lane, a financial analyst, is one of the first to publish on the use of stochastic oscillators to forecast prices. According to Lane, the stochastic indicators used to be the stochastic indicator is to be used with cycles, Elliott wave theory, and Fibonacci retracement for timing. In low margin calendar future spreads, one might use Wilder's parabolic as a trailing stop for a stochastics entry. A centerpiece of his teaching is the divergence and convergence of trend lines drawn on stochastics, as converging to trend lines drawn on price cycles. Stochastics predicts tops and bottoms. Interpretation. The signal to act is when there is a divergence-convergence in an extreme area with a crossover on the right-hand side of a cycle bottom. As plane crossovers can occur frequently, one typically waits for crossovers occurring together with an extreme pullback. After a peak or trough on the percent D line, if price volatility is high, an exponential moving average of the percent D indicator may be taken, which tends to smooth out rapid fluctuations in price. Stochastics attempt to predict turning points by comparing the closing price of a security to its price range. Prices tend to close near the extremes of the recent range just before turning points. In the case of an uptrend, prices tend to make higher highs, and the settlement price usually tends to be in the upper end of that time period's trading range. When the momentum starts to slow, the settlement prices will start to retreat from the upper boundaries of the range, causing the stochastic indicator to turn down at or before the final price high. An alert or setup is present when the percent D line is an extreme area and diverging from the price action. The actual signal takes place when the faster percent K line crosses the percent D line. Divergence converges is an indication that the momentum in the market is waning and a reversal may be in the making. The chart below illustrates an example of where a divergence in stochastics relative to price forecasts a reversal in the price's direction. An event known as open quote stochastic pop end quote occurs when the prices break out and keep going. This is interpreted as a signal to increase the current position or liquidate if the direction is against the current position. Relative Strength Index. The Relative Strength Index, RSI, is a technical indicator used in the analysis of financial markets. It is intended to chart the current and historical strength or weakness of a stock or market based on the closing prices of a recent trading period. The indicator should not be confused with relative strength. The RSI is classified as a momentum oscillator, measuring the velocity and magnitude of directional price movements. Momentum is the rate of the rise or fall in price. The RSI computes momentum at the ratio of higher closes or lower closes. Stocks which have had more or stronger positive changes have a higher RSI than stocks which have had more or stronger negative changes. The RSI is most typically used in a 14-day time frame, measured on a scale from 0 to 100, with high and low levels marked at 70 and 30 respectively. Shorter or longer time frames are used to alternately shorter or longer outlooks, more extreme high and low levels, 80 and 20, or 90 and 10, occur less frequently but indicate stronger momentum. The Relative Strength Index was developed by J. Wells Wilder and published in a 1978 book, New Concepts in Technical Trading Systems, and in Commodities Magazine, now Futures Magazine, in the June 1978 issue. It has become one of the most popular oscillator indices. The RSI provides signals that tell investors to buy when the security or currency is oversold or to sell when it's overbought. RSI, with recommended parameters in its day-to-day optimization, was tested and compared with other strategies in Marek and Zediva 2017. The testing was randomized in time and companies. Simply Gracia, Apple, ExxonMobil, IBM, Microsoft, and showed that RSI can still produce good results. However, in longer time, it's usually overcome by the simple buy and hold strategy. Calculation. For each trading period, an upward change U or downward change D is calculated. Up periods are characterized by the close being higher than the previous close. U equals close subset now minus close subset previous. D equals 0. Conversely, a down period is characterized by the close being lower than the previous period's close. Open parenthesis, note that D is nonetheless a positive number, close parenthesis. U equals 0. D equals close subset previous minus close subset now. If the last close is the same as the previous, both U and D are 0. The average U and D are calculated using the end period, smooth or modified moving average, open parenthesis, SMMA or MMA, close parenthesis, which is an exponentially smooth moving average with alpha equals 1 divided by period. Some commercial packages like AIQ use a standard exponential moving average EMMA as the average instead of Wilder's SMMA. Wilder originally formulated the calculation of the moving average as mu val equals open parenthesis prev val times open parenthesis period minus 1 close parenthesis plus new data close parenthesis divided by period. This is fully equivalent to the aforementioned exponential smoothing. New data is simply divided by period, which is equal to the alpha calculated value of 1 divided by period. Previous average values are modified by open parenthesis period minus 1 close parenthesis divided by period, which in effect is period divided by period minus 1 divided by period, and finally 1 minus 1 divided by period, which is 1 minus alpha. The ratio of these averages is the relative strength or relative strength factor, RS, equals SMMA, open parenthesis, U, and small letter n, close parenthesis, divided by SMMA, open parenthesis, D, and small letter n, close parenthesis. If the average of D values is 0, then according to the equation, the RS value will approach infinity, so that the resulting RSI is completely low, will approach 100. Relative strength factor is then converted to a relative strength index between 0 and 100. RSI equals 100 minus 100 divided by 1 plus RS. The smooth moving averages should be appropriately initialized with a simple moving average using the first n values in the price series. Interpretation. Basic configuration. The RSI is presented on a graph above or below the price chart. The indicator has an upper line, typically at 70, a lower line at 30, and a dashed midline at 50. Wilder recommended a smoothing period of 14. Open parenthesis, see exponential smoothing. It alpha equals 1 divided by 14, or n equals 14. Close parenthesis. Principles. Wilder posited that when price moves up very rapidly at some point is considered overbought. Likewise, when price falls very rapidly at some point, it is considered oversold. In either case, Wilder deemed a reaction or reversal imminent. The level of the RSI is a measure of the stock's recent trading strength. The slope of the RSI is directly proportional to the velocity of change in the trend. The distance traveled by the RSI is proportional to the magnitude of the move. Wilder believed that tops and bottoms are indicated when a RSI goes above 70 or drops below 30. Traditionally, RSI readings greater than the 70 level are considered to be an overbought territory, and RSI readings lower than the 30 level are considered to be in oversold territory. In between the 30 and 70 level is considered neutral, and the 50 level is a sign of no trend. Divergence. Wilder further believed that divergence between RSI and price action is a very strong indication that a market turning point is imminent. Bearish divergence occurs when the price makes a new high but RSI makes a lower high, thus failing to confirm. Bullish divergence occurs when the price makes a new low but RSI makes a higher low. Overbought in oversold conditions. Wilder thought that open quote failure swings and quote about above 70 and below 30 in the RSI are strong indications of market reversals. For example, assume the RSI hits 76, pulls back to 72, then rises to 70. If it falls below 72, Wilder would consider this open quote failure swing, end quote, above 70. Finally, Wilder wrote that chart formations and areas of support and resistance would sometimes be more easily seen in the RSI chart as opposed to the price chart. The central line for the relative strength index is 50, which is often seen as both the support and resistance line for the indicator. If the relative strength index is below 50, it generally means that the stock's losses are greater than the gains. When relative strength index is above 50, it generally means that the gains are greater than the losses. Uptrends and downtrends. In addition to Wilder's general theories of RSI interpretation, Andrew Cardwell, who has developed several new interpretations of RSI to help determine its confirmed trend. First, Cardwell noticed that uptrends generally traded between RSI 40 and 80, while downtrends usually traded between RSI 60 and 20. Cardwell observed when securities change from uptrend to downtrend and vice versa, the RSI will undergo a open quote range shift, end quote. Next, Cardwell noted that bearish divergence, number 1, only occurs in uptrends, and number 2, mostly only leads to a brief correction instead of a reversal in trend. Therefore, bearish divergence is a sign confirming to an uptrend. Similarly, bullish divergence is a sign confirmed to a downtrend. Reversals. Finally, Cardwell discovered the existence of positive and negative reversals in the RSI. Reversals are the opposite of divergence. For example, a positive reversal occurs when an uptrend price correction results in a higher low compared to the last price correction, while RSI results in a lower low compared to the prior correction. A negative reversal happens when a downtrend rally results in a lower high compared to the last downtrend rally, but RSI makes a higher high compared to the prior rally. In other words, despite stronger momentum as seen by the higher high or lower low in the RSI, price could not make a higher high or lower low. This is evidence that main trend is about to resume. Cardwell noted that the positive reversal only happen in uptrends, while negative reversal only occur in downtrends, and therefore their existence confirms the trend. Cutler's RSI. A variation called Cutler's RSI is based on a simple moving average of U and D, instead of the exponential average above. Cutler had found that since Wilder used a smooth moving average to calculate RSI, the value of Wilder's RSI depended upon where in the data file his calculation started. Cutler termed this data length dependency. Cutler's RSI is not data length dependent. and returns consistent results regardless of the length of or the starting point within a data file. RS equals SMA, open parenthesis, U, and small letter n, close parenthesis, divided by SMA, open parenthesis, D, small letter n, close parenthesis. Cutler's RSI generally comes out slightly different from the normal Wilder RSI, but the two are similar since SMA and SMMA are also similar. A complete guide to stochastic indicator. Last updated on September 24, 2019 by Rayner. Let me ask you, have you ever looked at a chart and noticed the stochastic indicator is overbought? So you immediately go short because you think the market is about to reverse. And here's what happened next. The market stalls, pause for a while, and then it blasts off higher. Clearly, you got stopped out of your trade and you wonder to yourself, what the fuck just happened? Well, you're not alone. That's why I wrote this stochastic indicator trading guide to teach you everything you must know about stochastic, how to use it, how not to use it, and why. Here's what you'll learn. Stochastic indicator explain what is it and how does it really work. The two deadly mistakes traders make when using stochastic and how to avoid it. How to use the stochastic indicator and predict market turning points. How to use the stochastic indicator and filter for high probability trading setups. How to better time your entries with the stochastic indicator. When not to use the stochastic indicator. Hint, it goes against what the gurus are telling you. Or if you prefer, you can watch this training video below. Stochastic indicator explained what is it and how does it really work. Now instead of me explaining what the stochastic indicator is about, here's what the founder of stochastic has to say. Open quote, stochastics measures the momentum of price. If you visualize a rocket going up in the air, before it can turn down, it must slow down. Momentum always changes direction before price. End quote. George Lane. In other words, the stochastic is an indicator that measures momentum in the markets. And for you math geeks out there, here's a formula to calculate it. %K equals, open parenthesis, current close minus lowest low. Close parenthesis, divided by, open parenthesis, highest high minus lowest low. Close parenthesis, times 100. %D is equals to 3-day SMA of %K, where lowest low is equals to lowest low for the look back period. Highest high equals highest high for the look back period. %K is multiplied by 100 to move the decimal point 2 places. Are you confused? Yeah, me too. That's why this image below will explain better. Open parenthesis using an 8-period stochastic. Close parenthesis. Equals $40 divided by $50 times 100 equals 80. Stochastic indicator settings. Now just a quick one. The settings on my stochastic indicator is open parenthesis 20, 1 and 1 close parenthesis, and it'll show a single line instead of the traditional 2 lines. Here's what I mean. Now there's nothing magical about it. I use 20 period because there are 20 trading days in a month. A single line is enough to interpret what it means. Does it make sense? Great. Then let's move on. 2 deadly mistakes traders make when using the stochastic indicator, and how can you avoid it? How you can avoid it? This is important. If you can avoid these mistakes, then you'll save yourself hundreds, if not thousands of dollars in the long run. They are, number 1, going long just because the market is oversold. Number 2, thinking the market will reverse because you spotted divergence. I'll explain. Number 1, you go long because the market is oversold. Recall. The stochastic is an indicator that measures momentum in the markets. So when it's at overbought level above 80, it means the market is strong bullish momentum. And the last thing you'd want to do is blindly go short just because stochastic is overbought. Here's why. The market continues to head higher even though it's overbought. As you can see, if you went short just because the market is overbought, it would have been a painful experience. Because the market can remain overbought or oversold for a long period of time, far longer than your account can withstand it. Next, let's move on to the second deadly mistake made by traders. Number 2. You think the markets will reverse because there is a divergence. A divergence occurs when the market price makes a higher high but the indicator shows a lower high, which means the two signals diverge from one another. Now, according to trading textbooks, courses, and etc., they will tell you that when you spot a divergence, it means a reversal is about to occur. But that couldn't be further from the truth. Here's an example. Bullish divergence that failed. As you can see, there is a divergence but the market didn't reverse. In fact, it continued to head lower for quite a while. Now, at this point, you've learned two biggest mistakes traders make when using stochastic and how to avoid them. Now you're probably wondering, so what's the correct way to use the stochastic indicator? Well, that's what I will share in the next section. Read on. How to use the stochastic indicator and predict market turning points. If you haven't realized by now, the reason why traders fail with stochastic is because you don't use it in the context of the market. You're probably thinking, what does it mean? Simple. Trade with the trend and not against it. If you look at the earlier examples, most of the common mistakes can be avoided if you're not trading against a trend. Make sense? Great. Let's see how you can adopt this principle and use stochastic to predict market turning points. Here's how. Number 1. If the price is above 200 period moving average MA, then look for long setups when stochastic is oversold. Number 2. If the price is below 200 moving average MA, then look for short setups when stochastic is overbought. Here's an example. The price is below 200 MA, so look for short setups. The overbought level should alert you that the pullback might end soon. Now, it doesn't mean you blindly go short when stochastic is overbought, but it can help you anticipate where the pullback might end, so you can better time your entry and trade with the trend. Can you see how a simple tweak make a big difference? Great, moving on. How to use the stochastic indicator and filter for high probability trading setups. I'm not sure about you, but whenever I put on a trade, I want to know where I am in the big picture. Why? Because if you want to find high probability trades, then you want to be trading with the higher time frame trend and not against it. So how do you do it? Well, you can use the stochastic indicator to filter your trades. Here's how. Let's say you want to go long on the 1 hour time frame. But before you do so, check the daily time frame and see where you are in the big picture. You want to make sure the daily time frame is not in downtrend with stochastic overbought, because that's where the market is likely to head lower and you don't want to be long. For example, most of you might want to go long based on the chart below. On the 1 hour time frame, you might want to go long after a bullish reversal pattern support. But if you look at the higher time frame, you will realize something is not right. The higher time frame is in a downtrend. The stochastic is at overbought level, so chances are the market is likely to continue trading lower and you don't want to be long. Not such a good idea, since a daily time frame is in a downtrend and stochastic is overbought. The market is likely to head lower. Here's what you should do instead. If the daily time frame is in a downtrend with the stochastic overbought, you look for a trading setup on the lower time frame to go short. Your entry trigger can be bearish breakdown from support on the 1 hour time frame. I'll explain. USD C slash CHF on daily time frame is stochastic overbought. USD slash CHF on 1 hour time frame breaking down from support. Can you see how it works? Great. How to use the stochastic indicator to better time your entries. Now, unlike chart or candlestick patterns where the entry can be subjective, the stochastic indicator doesn't give you that problem. That's because there's no discretion for the entry. It's either yes, you enter, or no, you stay out. So if you're the type of trader that's always unsure whether you should pull the trigger, and this entry technique is for you. Here's how. If you have a long bias, then go long with the stochastic line crosses above 20. If you have a short bias, then go short with the stochastic line crosses below 80. Here's an example. If you have a long bias, then go long with the stochastic line crosses above 20. Now, what does it mean? What does this mean? Recall. The stochastic indicator measures momentum. So when you see the stochastic crossing above 20, it's telling you bullish momentum is stepping in, and vice versa. And one important thing, don't mistake this as a trading strategy because it's not. Rather, it's an entry trigger to get you into a trade. A big difference. Why you don't need to use a stochastic indicator in a range market? Now, if you search the internet books, courses, etc., they will tell you the best time to use a stochastic indicator is in a range market. Why? Because you can wait for the price to be overbought before shorting, and vice versa. An example: black box equals overbought, blue box equals oversold. And from the books of it, it seems that the stochastic indicator can pinpoint the tops, bottoms of a range with deadly accuracy. But here's the thing. Do you really need a stochastic indicator to do so? Nah. Because all you need to do is buy support, short resistance, and viola. You get the same result. Here's what I mean. Buy support and sell resistance. Resistance and support. As you can see, you have accomplished the same thing as what stochastic did, but with less clutter in your charts. Does it make sense? Awesome. Conclusion. So here's what you've learned today. The stochastic is an indicator that measures momentum. Don't go short just because stochastic is overbought, because it can remain overbought for a long time. Spotting a divergence doesn't mean that the market will reverse. It fails more often than not in a trending market. In a downtrend, overbought level on stochastic can help you time when the pullback might end, and vice versa in an uptrend. The stochastic can serve as an entry trigger to go long when it rises above 20, and short when it crosses below 80. Now here's my question for you. How do you use the stochastic indicator? Relative Strength Index. The Relative Strength Index, RSI, is a technical indicator used in the analysis of financial markets. It is intended to chart the current and historical strength or weakness of a stock or market based on the closing prices of a recent trading period. The indicator should not be confused with relative strength. The RSI is classified as a momentum oscillator, measuring the velocity magnitude of directional price movements. Momentum is the rate of the rise or fall in price. The RSI computes momentum at the ratio of higher closes or lower closes. Stocks which have had more or stronger positive changes have a higher RSI than stocks which have had more or stronger negative changes. The RSI is most typically used in a 14-day time frame, measured on a scale from 0 to 100, with high and low levels marked at 70 and 30 respectively. Shorter or longer time frames are used to alternately shorter or longer outlooks, more extreme high and low levels, 80 and 20, or 90 and 10. occur less frequently but indicate stronger momentum. The Relative Strength Index was developed by J. Wells Wilder and published in a 1978 book, New Concepts in Technical Trading Systems, and in Commodities Magazine, now Futures Magazine, in the June 1978 issue. It has become one of the most popular oscillator indices. The RSI provides signals that tell investors to buy when the security or currency is oversold or to sell when it's overbought. RSI with recommended parameters in its day-to-day optimization was tested and compared with other strategies in Marek and Zediva 2017. The testing was randomized in time and companies. Exempli Gracia, Apple, ExxonMobil, IBM, Microsoft, and showed that RSI can still produce good results. However, in longer time, it's usually overcome by the simple buy and hold strategy. Calculation. For each trading period, an upward change U or downward change D is calculated. Up periods are characterized by the close being higher than the previous close. U equals close subset now minus close subset previous. D equals 0. Conversely, a down period is characterized by the close being lower than the previous period's close. Open parenthesis, note that D is nonetheless a positive number, close parenthesis. U equals 0. D equals close subset previous minus close subset now. If the last close is the same as the previous, both U and D are 0. The average U and D are calculated using the end period, smooth or modified moving average, open parenthesis, SMMA or MMA, close parenthesis, which is an exponentially smooth moving average with alpha equals 1 divided by period. Some commercial packages like AIQ use a standard exponential moving average EMMA as the average instead of Wilder's SMMA. Wilder originally formulated the calculation of the moving average as nu val equals open parenthesis prev val times open parenthesis period minus 1 close parenthesis plus new data close parenthesis divided by period. This is fully equivalent to the aforementioned exponential smoothing. New data is simply divided by period, which is equal to the alpha calculated value of 1 divided by period. Previous average values are modified by open parenthesis period minus 1 close parenthesis divided by period, which in effect is period divided by period minus 1 divided by period, and finally 1 minus 1 divided by period, which is 1 minus alpha. The ratio of these averages is the relative strength or relative strength factor, RS, equals SMMA, open parenthesis, U and small letter n, close parenthesis, divided by SMMA, open parenthesis, D and small letter n, close parenthesis. If the average of D values is 0, then according to the equation, the RS value will approach infinity, so that the resulting RSI is computed below will approach 100. Relative strength factor is then converted to a relative strength index between 0 and 100. RSI equals 100 minus 100 divided by 1 plus RS. The smooth moving averages should be appropriately initialized with a simple moving average using the first n values in the price series. Interpretation. Basic configuration. The RSI is presented on a graph above or below the price chart. The indicator has an upper line, typically at 70, a lower line at 30, and a dashed midline at 50. Wilder recommended a smoothing period of 14. Open parenthesis, see exponential smoothing. It is alpha equals 1 divided by 14, or n equals 14, close parenthesis. Principles. Wilder posited that when price moves up, very rapidly at some point is considered overbought. Likewise, when price falls very rapidly, at some point it is considered oversold. In either case, Wilder deemed a reaction or reversal imminent. The level of the RSI is a measure of the stock's recent trading strength. The slope of the RSI is directly proportional to the velocity of change in the trend. The distance traveled by the RSI is proportional to the magnitude of the move. Wilder believed that tops and bottoms are indicated when a RSI goes above 70 or drops below 30. Traditionally, RSI readings greater than the 70 level are considered to be an overbought territory, and RSI readings lower than the 30 level are considered to be in oversold territory. In between the 30 and 70 level is considered neutral, and the 50 level is a sign of no trend. Divergence. Wilder further believed that divergence between RSI and price action is a very strong indication that a market turning point is imminent. Bearish divergence occurs when the price makes a new high but RSI makes a lower high, thus failing to confirm. Bullish divergence occurs when the price makes a new low but RSI makes a higher low. Overbought and oversold conditions. Wilder thought that open quote failure swings and quote above 70 and below 30 in the RSI are strong indications of market reversals. For example, assume the RSI hits 76, pulls back to 72, then rises to 70. If it falls below 72, Wilder would consider this open quote failure swing, end quote, above 70. Finally, Wilder wrote that chart formations and areas of support and resistance would sometimes be more easily seen in the RSI chart as opposed to the price chart. The central line for the relative strength index is 50, which is often seen as both a support and resistance line for the indicator. If the relative strength index is below 50, it generally means that the stock's losses are greater than the gains. When the relative strength index is above 50, it generally means that the gains are greater than the losses. Uptrends and downtrends. In addition to Wilder's general theories of RSI interpretation, Andrew Cardwell, who has developed several new interpretations of RSI to help determine its confirmed trend. First, Cardwell noticed that uptrends generally traded between RSI 40 and 80, while downtrends usually traded between RSI 60 and 20. Cardwell observed when securities change from uptrend to downtrend and vice versa, the RSI will undergo a open quote range shift, end quote. Next, Cardwell noted that bearish divergence, number 1, only occurs in uptrends, and number 2, mostly only leads to a brief correction instead of a reversal in trend. Therefore, bearish divergence is a sign confirming to an uptrend. Similarly, bullish divergence is a sign confirmed to a downtrend. Reversals. Finally, Cardwell discovered the existence of positive and negative reversals in the RSI. Reversals are the opposite of divergence. For example, a positive reversal occurs when an uptrend price correction results in a higher low compared to the last price correction, while RSI results in a lower low compared to the prior correction. A negative reversal happens when a downtrend rally results in a lower high compared to the last downtrend rally, but RSI makes a higher high compared to the prior rally. In other words, despite stronger momentum as seen by the higher high or lower low in the RSI, price could not make a higher high or lower low. This is evidence that main trend is about to resume. Cardwell noted that the positive reversal only happen in uptrends, while negative reversal only occur in downtrends, and therefore their existence confirms the trend. Cutler's RSI. A variation called Cutler's RSI is based on a simple moving average of U and D, instead of the exponential average above. Cutler had found that since Wilder used a smooth moving average to calculate RSI, the value of Wilder's RSI depended upon where in the data file his calculation started. Cutler termed this data length dependency. Cutler's RSI is not data length dependent and returns consistent results regardless of the length of or the starting point within a data file. RS equals SMA, open parenthesis, U, and small letter n, close parenthesis. divided by SMA, open parenthesis, D, small letter n, close parenthesis. Cutler's RSI generally comes out slightly different from the normal Wilder RSI, but the two are similar since SMA and SMMA are also similar.